3 companies sell air, oxygen, nitrogen, argon, the 3 most abundant gases in the atmosphere. Combined market cap, over $500 billion. Combined revenue, nearly $80 billion. No new competitor has entered this industry in 40 years. This is the most boring oligopoly on earth and one of the most profitable. Gross margins above 40%. Take-or-pay contracts that lock in revenue for 10 to 20 years. Customers who physically cannot switch suppliers because the gas plant is welded to their factory wall. And yet, one of these 3 companies just lost its CEO, wrote off $3 billion, and is burning cash faster than any industrial company in the S&P 500. Same industry. Opposite outcomes. This is the industrial gas paradox. 3 questions this episode answers. First, how does selling the most abundant substance on Earth become a $500 billion business? Second, why did Air Products CEO get fired after betting $15 billion on hydrogen, and why did the board replace him with a Linde executive? Third, which of these 3 companies actually deserves the premium investors are paying? Let's start with why this industry exists at all. The global industrial gas market is worth roughly $119 billion. It's growing at about 6% a year, driven by semiconductors, healthcare, and the energy transition. 3 companies control over 70%, Linde at 35% share, Air Liquide at 25%, and Air Products at 10 to 12%. 2 smaller players, Nippon Sanso and Messer, split another 12 to 14%. Everyone else is regional. The products are simple. Oxygen for hospitals and steel mills. Nitrogen for food packaging and semiconductor fabs. Argon for welding. Hydrogen for refineries and, increasingly, for clean energy. The raw material is literally air. The cost is electricity running an air separation unit that cools air to negative 190 degrees Celsius and distills it into its components. The technology has been mature for a century. There is nothing proprietary about the chemistry. And yet margins are 40% or higher. That contradiction, commodity product, franchise economics, is the entire story of this industry. The moat in industrial gas is not technology. It's physics. An air separation unit costs $200 million to $1 billion to build. The output, liquid oxygen, nitrogen, argon, is heavy and expensive to transport. Cryogenic liquids boil off during delivery. The economic radius of a plant is roughly 300 kilometers. Beyond that, transportation costs destroy the margin. So the business model is this: you build a plant next to your customer's factory. You connect it with a pipeline. You sign a take-or-pay contract, typically 15 to 20 years, where the customer guarantees minimum purchase volumes regardless of whether they actually use the gas. The price is indexed to electricity costs, so commodity risk passes through. Once the pipeline is in the ground, switching suppliers means physically demolishing one plant and building another. No customer does this. The relationship is permanent. This is why no new competitor has entered the industry in 4 decades. You don't just need capital. You need an installed base of plants, pipelines, truck fleets, cylinder distribution networks, and regulatory approvals across dozens of countries. Building that from scratch would cost tens of billions, and the incumbents would undercut you on price during the decade it takes to scale. The result is an oligopoly protected not by patents or software, but by concrete, steel, and the laws of thermodynamics. 5 companies. 1 industry. Very different strategies. Linde, $34 billion in revenue, 29.8% adjusted operating margin, $5.1 billion in free cash flow, $230 billion market cap. The disciplined compounder. Record $10 billion backlog. $4.6 billion in share buybacks last year alone. Air Liquide, €27 billion in revenue, operating margin just crossed 20% for the first time in the company's history. $115 billion market cap. Unique healthcare division serving millions of patients directly: sleep apnea, respiratory therapy, home oxygen. Growing its semiconductor gas business with 15-year contracts at new chip fabs in Dresden and Singapore. Air Products, $12 billion in revenue, adjusted operating margin 24%. But here's where it gets interesting: GAAP operating loss of negative $877 million. $3.7 billion in write-downs. Free cash flow, negative $3.8 billion. Market cap, $65 billion, less than a third of Linde. Nippon Sanso, Japan's largest, strong in electronic specialty gases for semiconductor manufacturing. Messer, the only private major, focused on Europe and China. Same industry. Same products. Linde's market cap is 3.5 times Air Products. The gap isn't about what they sell. It's about what they chose to do with the cash flow. Linde is the gold standard in industrial gas and arguably in industrial companies, period. Fiscal 2025, $34 billion in revenue, up 3%. Adjusted EPS $16.46, up 6%. Operating cash flow $10.3 billion. Free cash flow $5.1 billion. Adjusted operating margin, 29.8%, approaching 30%, which is extraordinary for a company this size. Capital allocation tells the story. Linde returned $9 billion to shareholders in 2025, $4.6 billion in buybacks and $1.6 billion in dividends. The share count has been declining 2% a year for a decade. This is a company that treats its equity like a depreciating asset, constantly shrinking the denominator. At the same time, it's investing. The project backlog hit a record $10 billion, two-thirds in clean energy and electronics. But these are disciplined bets, hydrogen projects backed by blue hydrogen with carbon capture and 45Q tax credits, not speculative green hydrogen in the desert. 2026 guidance, adjusted EPS $17.40 to $17.90. 6 to 9% growth on a $34 billion revenue base. No drama. No write-offs. Just compounding. The stock is near all-time highs at $492. Dividend yield 1.3%, growing 9% a year. This is what a franchise looks like when management doesn't get bored. Air Products made the single biggest strategic bet in the history of industrial gas, and it nearly destroyed the company. Under CEO CFI Gassamy, Air Products committed $15 billion to large-scale hydrogen projects. The centerpiece, NEOM Green Hydrogen in Saudi Arabia, a joint venture with ACWA Power, building 4 gigawatts of solar and wind to produce 600 tons of green hydrogen per day as ammonia. The original budget was $5 billion. It's now $8.4 billion, a $3.4 billion overrun driven by inflation, interest rates, and scope creep. Construction is 90% complete. First ammonia production is targeted for 2027. But here's the problem, only one customer, Total Energies, has committed to buy the output. Roughly two-thirds of the ammonia has no signed offtake agreement. Air Products is building a world-scale facility without knowing who will buy most of the product. Meanwhile, the core business starved. Free cash flow turned negative $3.8 billion. In February 2025, the board exited 3 U.S. clean energy projects and took a $3.1 billion write-down. The GAAP operating result for fiscal 2025, negative $877 million. Activist investors D.E. Shaw and Mantle Ridge forced a full board overhaul. Gassamy was ousted. His replacement, Eduardo Meneses, a 30-year Linde and Praxair veteran. The irony is hard to miss. The board hired the competition's playbook to fix the mess. Air Products remains a dividend aristocrat, 44 consecutive years of increases. But the dividend is funded by debt, not cash flow. That's a red flag with a timer on it. Air Liquide is the company investors overlook because it's French, it trades as an ADR, and it doesn't generate headlines. That's a mistake. Fiscal 2025, €27 billion in revenue. Operating margin crossed 20% for the first time in the company's 100-plus year history, a structural milestone, not a one-time event. The advanced strategic plan delivered 160 basis points of margin expansion over 4 years. What makes Air Liquide unique is healthcare. 16% of revenue, over €4.5 billion, comes from medical gases and home healthcare services. This isn't bulk oxygen to hospitals. Air Liquide directly serves millions of patients for sleep apnea, respiratory therapy, and diabetes management. Recurring, subscription-like revenue with minimal churn. No other industrial gas company has this business at scale. The second edge is semiconductor specialty gases. Air Liquide supplies ultra-high purity carrier gases to chip fabs, 6/9 to 7/9 purity levels where a single contaminant particle kills a wafer. It just signed a 15-year contract to supply a major semiconductor customer in Dresden and is building new facilities in Singapore for AI-era chip production. Dividend, 30-plus consecutive years of increases. The stock trades at a discount to Linde but has been re-rating as margins expand. The target is another 100 basis points of margin improvement in 2026. So where does the margin actually live in this business? 3 delivery modes, 3 different economics. On-site, also called tonnage. A dedicated plant built at the customer's facility, connected by pipeline. Lowest margin per unit, but highest volume and highest predictability. Take or pay contracts, 15 to 20 years. Revenue behaves like a utility. This is Linde's core. Merchant bulk liquid delivered by cryogenic tanker truck. Mid-range margin. The supplier operates a regional network of plants and trucks. Economic radius matters, beyond 300 kilometers, logistics eat the margin. This is where scale and route density create advantage. Packaged, small cylinders for hospitals, welding shops, laboratories. Highest margin 30 to 40% gross, but highest logistics cost. Pricing power comes from convenience and certification requirements. Air Liquide's Airgas acquisition in 2016 for $13 billion gave it the #1 U.S. cylinder distribution network. The key insight: the closer you get to the end user, the higher the margin. Bulk commodity gas at the pipeline is low margin but locked in. Specialty cylinders at the hospital bedside are high margin and defensible. The winners operate across all three layers simultaneously. My read on how to approach this sector. Tier 1 Linde. The franchise. 29.8% operating margin, $5 billion in free cash flow, declining share count, $10 billion backlog, disciplined hydrogen exposure via blue hydrogen and tax credits. The stock is not cheap, but franchises rarely are. You pay for certainty. Near all-time highs at $492. Tier 2 Air Liquide. The underappreciated compounder. 20% margin milestone just achieved. Healthcare moat gives it a revenue stream no competitor can replicate. Semiconductor gas exposure growing fast. Trades at a structural discount to Linde, which may narrow as margins keep expanding. The best risk-reward in the sector if you have patience. Turnaround watch Air Products. New CEO from Linde. Activist-driven board reset. NEOM is 90% built, the question is whether offtake materializes. If Menezes refocuses the company on its industrial gas core and NEOM finds buyers, APD re-rates significantly from $65 billion. If NEOM offtake fails and the dividend gets cut, the downside is severe. This is a binary outcome, not a compounder. Size accordingly. 3 signals worth tracking over the next 12 to 18 months. First, NEOM offtake contracts. Air Products needs to sign binding purchase agreements for the remaining 2/3 of NEOM's ammonia output by early 2027. If signed, APD re-rates. If not, the write-down risk escalates and the dividend comes under pressure. This is the single most important catalyst in the sector. Second, Air Products strategic reset. CEO Menezes has exited 3 projects and taken $3 billion in charges. Watch for further asset sales, capex reduction below $4 billion, and whether free cash flow turns positive in fiscal 2026. The speed of this turnaround determines whether APD is investable or a value trap. Third, semiconductor gas demand. Electronics is the fastest growing segment in industrial gas, 8 to 10% annual growth driven by AI chip buildouts. Both Linde and Air Liquide are signing long-term fab supply contracts. Watch capex announcements from TSMC, Intel, and Samsung. Each new fab is a 15-year revenue stream for the gas supplier next door. My base case, Linde continues compounding at 6 to 9% EPS growth. Air Liquide re-rates as margins hit 21%. Air Products stabilizes under new management but remains volatile until NEOM proves itself. The boring oligopoly keeps printing money, the only question is who captures the hydrogen upside without destroying the core. I'm Big Z, follow me, see you in the next deep dive.